So Scott, okay, here we are live. Thank you so much for joining us. We're going to call this live segment going forward, Real Estate Investor Market Update. And what we're trying to do, it's kind of a trying time right now. We want to add some clarity. We want to take the fear out of what's going on. Almost all of our guests, well, I'm assuming all of our guests have already been through these market changes.
Yeah.
I know I've been beat up a lot. So, and I'm old. So it's not only do I bruise easy because of my age, it adds a little bit of wisdom. And we've seen these cycles before. Mm-hmm. We believe this is going to be temporary. My name is Bill Fairman. I'm with Carolina Capital Management. This is my co-host, Jonathan Davis. I am currently getting a feedback in my ear, so if I'm hesitating. My name is Bill Fairman. I'm with Carolina Capital Management. What I'd like to do is introduce our guests. If all of our guests will put themselves on mute for a moment, that will help me out. Again, not only am I old, but I'm easily confused. So we have with us today Mike Zlotnik of Tempo Funding. He's in the Brooklyn area of New York. He does a lot of he does lending as well as commercial properties in a fund, and he's also a mathematician by trade. So he very smart guy. He always sounds a lot smarter than the rest of us. We also have Jacob Vanderslice. He's with VanWest Partners. They also are in the commercial space. I think most of that is in the self-storage. Not if I'm saying that correct. Okay. Yeah. He says yes. We have Glenn Stromberg of Stromberg Investment Group. He is in what we like to call the real estate space. So he specializes in mobile homes on land, and all of those are for turnkey rental purposes. Mm. We have Chris Miles of Money Ripples. He is the anti-financial advisor, and we're going to talk about a lot of stuff from his perspective. And we have Fuquan Bilal, which is he's not on yet, but I'm assuming he will be here shortly. He's with NNG Capital. So before we get started, guys, I'd like to talk about the bill that was passed last night by the Senate. Mm-hmm. There's a couple little things I want to highlight in there. If you're a small business owner and you're worried about keeping cash flow going, this is going to help. But if you need it tomorrow, it's not going to help.
Yeah, if you need it tomorrow, it's not. But if you can hold tight for 2 or 3 weeks, I think it will definitely be very helpful to a lot of small business owners.
By the way, before I get into this any further, I want Jonathan's wife to realize we are more than 6 feet apart. It's just when you're on camera, it makes you look a lot closer.
That's right.
It adds weight, but it also makes the room look smaller. He's not really this close to me. So a couple of little highlights from the bill is your local bank. If you have a bank relationship with your local banker, that's where you need to go to get this stimulus loan. Mm-hmm. And it's going to be for payroll taxes, health insurance benefits that you're paying your employees, rent or mortgage, mm-hmm. utilities, insurance payments.
Yeah.
I'm not sure how long for, but it's going to be a fully guaranteed loan from the government. So it's going to be a lot easier for the banks to underwrite these because, hey, they're going to use their standard underwriting practices. However, they're not going to really hesitate not to give a loan.
Yeah, knowing that
as long as you're a qualified, borrower, mm-hmm. because the government is going to back it up. And if you, don't, and by the way, there's a little bit of, it's also payroll, and there's a little bit of concern on whether it's for retention or rehiring, and it did say rehire and retain,
No, I thought it was for
or
both.
retain
Yeah.
and rehire.
Mhm.
A lot of people are concerned there because we can't wait for government. A lot of us had to move, right away because, hey, you had no revenue coming in. You had people there not working. What are you going to do? You can't wait for government to make up their mind.
Mhm.
And by the way, it's going to be 10 days before they even get guidelines on this, and it still has to be passed by the House.
And Nancy Pelosi.
So it's going to be a little while before you get there. But what you need to do is make sure you call your local banker right away. Make sure
Yes.
you get in line.
Mhm.
Let them know that you want to do this, and go ahead and get your normal stuff that you would get for a loan, your tax returns, your balance sheets, all that stuff, right?
Yeah. Go ahead and get it started. Yes. Yeah. No matter what the guidelines end up being, it's always prudent to get going.
Yeah.
Yeah.
And if you're trying to get these SBA loans that are for disaster stuff, some of us heard some horror stories last night from a dentist that was involved in a flood, and it was a nightmare trying to get that same kind of disaster
Mhm.
SBA stuff. And
Yeah.
they ended up coming out of pocket with most of it. So, okay. Call your banker, get this all set up.
Yeah.
I'm going to start off with a question to, before I get there. Hey, Fuquan,
He's trying to
just
get on.
smile.
He's on.
So I want to tell everyone that's watching, you can chat and ask questions to the panelists. We'll see them, and if time allows, we'll ask them while we're on the air. If not, then we'll try to answer them offline. So, Jacob, I'm going to start with you. What part of the commercial real estate space do you see having the biggest issues, short term, long term, and why?
He needs to unmute himself.
All right. Maybe I need to unmute you.
He said 1 moment.
Okay.
There it is.
Got it fixed.
That's okay.
Yeah, thanks for having us on. My name's Jake Vanderslice. I'm a principal at VanWest Partners. We're a private equity real estate investment company based out of Denver. We focus on a variety of asset classes, mainly self-storage. We've got some retail. We do residential as well. The fallout that we've seen so far that's been most precipitous and most alarming is within retail and hospitality. I mean, you've got most of America right now, especially in our geography, where retail businesses have completely shut down. Tenants can't pay their rent. Landlords have a problem servicing their debt. We've heard of a lot of discussions on payment deferrals with various landlords and their bankers. So retail has definitely been a big one that we're seeing. Another one that we're seeing too is hospitality. I think before the virus really spooled up, vacancy or commercial or hotel occupancy rather in Denver was roughly at about 5% before they closed all the hotels. Typically in March, they're tracking around 71% occupancy. So just a precipitous drop there. So those are really the two big asset classes that we're concerned with, retail and hospitality. A third, which hasn't really manifested itself yet, we think is going to be workforce housing, especially, C+, B- multifamily. A lot of the tenant base in those product types are hand to mouth, retail workers making $20 an hour. They're bunked up with roommates, and those guys are losing their jobs. So we could see a problem happening there too. But those are the three main areas that we're concerned with.
Excellent. So, Mike, let me pose the same question to you.
Sure. Mike Zlotnik, fund manager. Easy way to find me is bigmikefund.com. That's the name of the podcast, and that's our website. I'm a fund manager. We have a broad, diversified portfolio of assets. And the areas of concern, for sure, as Jake mentioned, hospitality. That is in a deep, deep hole, and it'll continue to be there. And we're already seeing all kinds of data confirming that. Retail, I literally just had a call with a shopping center operator who does have a number of shopping plazas, not the malls. And they're waiting for the data on April 1st. Most of those malls are, well, not malls, I'm sorry, shopping centers are grocer anchored. So grocery stores are staying in business, and they're likely going to continue to pay. People need to eat, even though there's a shift to delivery versus going to a store. But shopping plazas with some of these essential businesses probably will survive. They're certainly going to take some level of a beating. So that sector, again, not shopping oriented. Plazas are okay. Big malls are in horrible shape for sure. The one sector that seems to be picking up, and again, this is a contrast. Some's going down, something else going up, is a self-storage. The data we're seeing is that the self-storage is picking up right now as economy is going to hit it. It's going to likely hit the recession. The self-storage generally does pretty well. Some office might get hit, obviously closed. So the office that leases to brick and mortar is in difficult times. The office space that leases to the businesses that can operate remotely can continue to pay rents, maybe somewhat reduced rents. But if it's a white collar, when the crisis passes, those offices will continue to operate. We expect some level of demand falling for the office space over the next few years, but in the short run, really, the key question to ask is what type of tenants they have and whether it's a blue collar or white collar employment. The white collar will do fine, or at least not as bad. The other sector that as Jake mentioned, might take some level of a correction is affordable housing, although it's really a function of how affordable. If most folks in those apartment complexes are Section 8 and they're getting government help on employment, they're probably going to continue to pay rent. There's nowhere to downgrade. So, but the blue collar, sort of somewhat above that, there's going to be a trench of blue collar multifamily. Those will take some level of a beating if this is a prolonged recession and prolonged crisis. But the very low end probably will be okay because of the government support. So,
thanks, Mike.
There's going to be a shift, obviously, in the market. If you've shifted your restaurant business to really takeout or delivery, you don't have to be in a retail place. You can have that business in a more of those warehouse type spaces, because you're not really going to have that many people coming if you're delivering. So my next question to you two, and let's start off with Jacob. Where do you see the properties that are going to be worth more, or the biggest positive changes?
Well, it's easy to say because we're in the business already, but definitely self-storage, as Mike had mentioned. Within our portfolio, we track net rental activity on a daily basis. And net rentals is the difference between the number of move-ins and move-outs. So, for example, January 1st to the 26th, we had about 18 or 20 net rentals. It was roughly the same for the time period in February. And for the month of March now, through March 26, we've seen 65 net rentals across our managed portfolio. So part of that seasonality, but I think part of it too is maybe people are cleaning out their homes, kind of getting ready to be strapped into their houses for a while. People are moving. A lot of kids are coming back from college because they can't be at college anymore, filling up storage units. So we like storage as an asset class, and we think it's going to perform well during this downturn. And I do think, as afraid of workforce housing as we are, we think that's a very defensible asset class as well. There's always going to be a need for workforce housing, especially as affordability becomes more of a challenge. Wage growth is not meeting home price appreciation. We kind of see a nationwide shift to being more of a country of renters than a country of homeowners. And beyond that, I'm not sure where the flight to stability is right now. In general, across all the asset classes, I think investors should be focusing more on income and cash flow than they are capital appreciation. I think that net worth is not going to mean as much in the coming months or the coming year as cash flow does. And cash flow solves all problems. So we're trying to focus on deals that only produce existing income streams as they are versus taking major risks on deals that are empty with no revenue.
Right. Well, you also forgot the possibility of those extra people hoarding their toilet paper and hand sanitizers. They need that self-storage for that.
That's
Mike?
right. Exactly.
What about you, Mike?
So I concur with Jake. We are very cash flow focused today. You've heard me speak about the quadrants methodology. So we like investment grade quadrants focused on cash flow or very defensive things with downside protection. I do think that going forward, it's going to be a lot of surgical precision, looking for deals that have those characteristics. We do invest quite a bit in hard money loans and defensive commercial debt at low investment to value ratio. So those type of deals with good downside protection and experience in strategy execution could provide significant opportunities. Again, distressed commercial debt is counter-cyclical. Just an example, again, I'm in New York City here. Some of these, there will be failures, and the landlords will be defaulting on more and more of these loans. And that's an opportunity to scoop them at a great price and take advantage, again, not being a vulture, but trying to salvage these type of situations where the great assets could go at a discount, and instead of buying them, you buy the paper, the first lien mortgage that that is in a senior position on the capital stack, and foreclose on them or work out a deal where you get repaid with a good return. Those are very defensive type of investments because you're in a senior position. Obviously, self-storage itself, the new projects. The new origination has to be very strategic. That whole business is a 5 mile, 3, 5, and 1 mile radius business. We do like those. We have a number of those assets in the portfolio today. All the new stuff we're doing in that sector is essentially very cash flow focused. There will be other opportunities. So the world is not ending tomorrow. There will be great deal on many multifamily assets, on some shopping centers and so on. There's going to be a retrade. It's already happening today. So retrade simply means that what sold for 10 million a month ago will trade now for 7.5. Now, what's happening in the short run, mortgage, the CMBS markets, commercial mortgage-backed securities markets are frozen. So there are no lenders who want to fund those deals. But when this market restabilizes and the lenders will come out and fund again, the values, the trade values will come down quite a bit. But the cash flows have to stabilize and reset. In other words, there's a lot of uncertainty who's going to pay rent on April 1st, who's going to pay rent May 1st, who's going to pay rent June 1st. Once that shakes in, and there's going to be significant level of retrade, and the opportunities will come up. So literally 20, 25, 30% discounts are very possible once the numbers shake through. So the opportunities are going to be coming up, significant opportunities in the commercial space. You just need to understand what they look like so that you can invest with great confidence that you're getting a good deal.
Yeah, I completely agree with Mike there on the paper, on the commercial paper. And if you want to know more about that, visit Mike's website, or if you have questions about it, I spent several years doing that myself. So there's many people on here that you can talk to about that. Does anyone have any questions or comments? Anyone on the Chris, Glenn, Jacob, Fuquan, anything that you want to say?
Well,
No.
we do have a question from Sohill,
Mm-hmm.
who asked in the chat box, and basically his question is, what are the banks doing since the landlords can't evict, tenants for non-payment for a particular period of time? So my feeling on that is it depends on who the bank is. Your bigger banks, your Chase, your Wells, and Bank of America, they're going to give a little forgiveness for a few months too,
3 days.
because, they've already made a deal with the state of California for the owner occupant type mortgages. I don't see that they're going to change that for the commercial loans, but some of your smaller banks, you're just going to have to call them. That's basically how it works. Most of them aren't going to volunteer to take deferrals.
Yep.
You're going to have to prove to them that you're going to have issues.
Yeah, your core business or whatever it is has been affected
Yeah.
by this virus. Yeah.
The bigger banks, they have a big PR stuff going on. They're not going to volunteer it. You're going to have to ask. Glenn, did you have something to say?
Yeah, I do. This is something that not only for banks, but for us too. We've got 350 properties under management. So there is a 60-day moratorium. You cannot foreclose. So, but it does not alleviate people from the rent payments. So we are expecting some bumps in the road. Obviously, fortunately, about 50% of our tenants are Section 8. So that'll take care of itself. Mm-hmm. There's other government programs coming out for assistance. Of course, the stimulus package is going to help on that too. So like what we did was we sent out a letter just saying we understand what's happening out here, but please understand, there will be some grace here, but the money is still going to eventually be due, and we're going to be understanding here the next 60 days. But you're still responsible for the rent, and we're showing them the programs to go and to check into and to help them to get the help that they need.
Yeah, I've got one example to offer there too. On our retail portfolio, for example, we proactively approached all of our tenants and said that we're going to defer 2 months of your base rent to kind of get them through this. I mean, our success is their success, and if they can reopen when this is over, we're all going to be better off for it. And on the bank side, in terms of what banks are doing with these payment deferral issues, one of our banks automatically offered us 6 months of interest-only payments instead of amortizing. And that'll save us quite a bit of money. And I was talking to one of our bankers right now, and as you can infer from what I've been working on the last week, which Bill mentioned earlier, it's been talking with bankers often and regularly. There's a regional bank in Kentucky. We're buying a few self-storage facilities out there next month. And they had mentioned that they forecast over 75% of their commercial loan portfolio to go into payment deferral. And they're still down to lend. They're still doing deals, and they're still moving forward. But this is a systemic issue, and it's been kind of refreshing to see, kind of contrary to the last downturn, that everybody is being touched by this, lenders, landlords, and tenants, and everyone's working together to get through it.
Yeah.
I have one quick comment on this. So it's exactly the case we were all in this together. So I place a call. My wife is an optometrist here in Brooklyn, New York. We're closed, and I did call our equipment lender, Wells Fargo Bank. In 15 minutes conversation, 90-day deferral immediately. They already have a policy in place for all distressed areas. All you have to do is call, request deferral, they'll deferral. That's the basic step you can do for now. So it's sort of a mitigation for 2 or 3 months at this point. If this is a prolonged problem with people out of work for more than 90 days, there will be probably step number 2. You can call back and get another few months. They understand. I think there's a moratorium on foreclosures, moratorium on evictions. So just proactive conversations take care of it. If you have tenants and they have an issue, just be prepared that you have to do something to help them out. And that's the way to do it. Do it together, do it as a united country, and we'll get through this. But the banks are certainly very, very responsive today. All you do is call, explain that you're in a disaster zone, you're closed, and they'll do an immediate deferral at menu.
Yeah, definitely agree. I think being proactive, as the other panelists mentioned, being proactive and reaching out to your tenants, whether you have a large rental portfolio, and or reaching out to your lenders and explain the situation. I mean, we're fortunate enough to have a very high percentage, I would say around 85% of our rentals with subsidized programs from New York and Section 8 and things like that. Those programs for those landlords who have that in place, they won't be as, they won't feel the impact like most of the people who are just, who have cash tenants. We've actually received a few calls, not many, on the note side, where we had some performing notes where people were asking, what type of what type of programs that we have in place in order to help out with the current situation. So we have been in contact with our loan servicers, and like everyone else, we're willing to give a helping hand to the current situation. Everyone will be impacted from this. This would definitely make everyone stronger, and for whatever's next to come. But there will be down the line possible opportunities for people who position themselves over the last couple of years. We've been in a very aggressive market. It's been a seller's market, forever. So this was, inevitable. But it's something we just have to take day by day and make sure that we're executing on the plans. The benefit that, I see in all this is definitely more family time and more time to really evaluate your strategy and, the people that's in your circle and who you're doing business with. I actually had a question on the private lenders. How are they being impacted? The hard money lenders and stuff like that. I haven't heard too much. I'm hearing about the big banks, what they're doing, to the homeowners. But what are you guys hearing on the private lending and the hard money lenders who may have projects up and running that's been stopped due to townships not coming out doing inspections and stuff like that? Are you guys? Well, of course, the first didn't roll around yet. But what are you guys seeing on that end?
Well, that's a good question, and that kind of I'm going to talk about that here in just a second. I know Jim and Mark both had questions, and I'm going to answer Mark's first, and then I'm going to kind of give you a take on what we're doing, on the private lending side. Mark had do we have any recommendations for alternatives to Pier Street? They basically didn't close his loan 20 minutes before he was supposed to close.
And I think to clarify that's a long-term loan.
Right.
That was a long-term loan.
And that's what I was going to mention. We have almost every lender out there that has institutional capital behind them or put a complete pause on any long-term rental loans because they aren't sure about valuations going forward.
Yeah, and the secondary market was frozen when they made that decision.
Yeah. And they sell those things off too, and they're in a position right now where there's too much unknown. That's going to be temporary till they figure out how valuations are going to go, and then they'll start lending again. And that gets back to us and our portfolio. So we're a private lender. We're working through a few deals that were already in the pipeline. We're not stopping those in the middle of closing. We're going to finish those out, but we're putting a pause on everything else coming in. We want to see how the valuations are going as well.
Yeah.
Fortunately, we're in an area in the Southeast where things haven't been completely closed down. Construction is still allowed to go on. The largest county in our area is Mecklenburg County. That's the county that Charlotte is in. They have a mandatory, hunker down at home order. But construction was an industry that they felt was vital, and you're allowed to go to work.
Yeah.
However, the county government is, kind of shut down, and they're not going out and doing inspections. So you can only do so much construction work before you have to move to the next phase, and you have to have it inspected before you can move to the next phase.
Yeah.
So I don't know how that's gonna play into that.
And I saw, Mark, your comment about totally with short term and 5 years fine. The issue is still the valuations. It's the LTVs. It's the unknown right now for them. So if you're looking for 70, 80% loan to value right now on current valuations, I think most people are kind of out of that right now, and everyone's kind of sticking to 50 to 60 and lower for sure.
Right.
And that's if they're even lending at that LTV.
Yeah.
So
and it's everybody. Everyone in that industry is on pause right now until they can get a better handle on the valuations.
Yeah.
Bill, I'll just second that. It's exactly the conversation. Secondary markets are completely frozen, and major players in the industry turned off, especially Wall Street backed. The portfolio lenders are doing exactly that. They're tightening up underwriting. So you may still get a file here and there. We are still doing a few final loans with the old relationships, top clients. I actually had conversation with a couple of top guys who do 20, 30 fix and flips per month. And some are operating just fine if they haven't been shut down or the real estate is considered to be essential in their state, and some are closed. So the ones that are closed, asking for a discount, deferral of interest, and we'll work with them. And those who are operating and are able to get deals, they're getting deals actually at a better price. They're retrading their offers, coming back, lowering them, and they are trying to do the work. But the focus is on the most affordable range. That's the only range we're looking at. Turnkey range, sort of as affordable as it gets in the cities that don't fluctuate much in value. And I believe that there's going to be some level of continuous construction in some cities, and some will be completely turned off. Like we had a conversation with a gentleman from Philly, they're off. The Quad Cities are on, and then the pockets here and there. But all major players they disconnected for the next couple of months, most likely, until things stabilize. I hate to say this, but if you will have a loan request, just be patient. There's not much you can do. You could send a lot of emails, a lot of requests. 90% of players are going to be turned off at this point of time.
You know, it's funny. I saw that the governor of Idaho put a shelter-in-place order too, and they're one of the least populous states out there. So I know they have pockets of population, but even the ones that don't have a lot of population are starting to do this. Do you want to ask the next question?
Yeah, and we need to get to Jim's question at some point.
Well,
but,
yeah, I'm going to actually.
But you're going to answer that
I'm
later.
going to take Jim's question and ask everybody at the end.
Okay, got it.
Yeah.
All right, Glenn, my question is for you. I believe that most of your tenants seem to be in somewhat rural areas in your real estate. Do you think that that's an advantage or a disadvantage, and kind of walk me through that?
You know, that's hard to say for sure, but I would say to some degree it's an advantage. They're away from the populous centers. You know, I'm here in downtown Fort Worth, walked to my office this morning, and there is nobody here. I mean, there's nobody here. The place is shut down. I think rural areas are a little bit more free to travel and so forth. But you know, only time's going to tell. We're in uncharted territory here. It's really a tough. You know, I heard a guy say this, that, you know, after 9/11, the 2008 crash, right? Everyone was able to dust themselves off and go back to work the next day. You know, today we can't go to work, right? That's the problem. So I think that, you know, the jury's out on that, but I would say, yes, I believe that that's going to be, you know, somewhat of an advantage, but I'll probably know a whole lot better in 60 days.
Yeah. Thank you. All right. And my next question is for Fuquan. You invest in a variety of real estate backed assets. Are you leaning to any particular asset type, or are you, you know, steering away from any others? And kind of walk us through that. What are you gravitating towards?
So the assets I invest in are real property, local here in New Jersey, where I've been investing the last 20 years, and also notes nationwide. So again, we don't have a crystal ball, but we believe, you know, in the future, possibly sometime around Q3, the mom and pop landlords, you know, will be flooding, trying to get liquidity. We actually have a marketing campaign in place now to try to do more buying on terms for people who need fast liquidity, who can't refinance. So that's the strategy that we're applying now, and we are not buying any more high-end fix and flips. So maybe probably about 10 months ago, I kind of switched over to lower end, you know, buy and sell properties, $350,000 resale price or less. Mm-hmm. And also, you know, with the rentals, because we have relationships with Battered Women and Children Program, Section 8, where we rent subsidy units. So we're still increasing our rentals. So we can find, you know, someone who is looking for liquidity. We're exercising that option to kind of help them out, and also take control of the property, and, you know, do whatever upgrades need to be done, and get someone who is in the subsidized program into the unit so we can, kind of count on that cash flow. As far as the notes, and it's been a seller's market, as I mentioned, both for real estate and notes. So we just made a trade in Q1, and we're kind of still going through the onboarding process of that. We're actually probably, unless it's, single buyers, single people who have assets want liquidity, who's willing to, get favorable pricing, will definitely execute on that. But that's really the strategy. We're still doing notes and we're still doing real estate, more rentals than a flips, because again, we don't know where the pricing is going to be 15, 20%. You're hearing all types of stuff, but no one has a crystal ball. Like everyone else, we're just making sure that we have liquidity, and that, when the opportunity arises, that we can, definitely benefit from that. Again, first and foremost, the landlords that are looking for liquidity and have stuff in our geographical area, we're going to execute on that. And if we find opportunities in notes, it's still the same strategy, but just, no more high-end stuff. I actually have one high-end property now in the market, put on the market Valentine's Day, and who knows where the pricing is going to be reset to that, but there's enough equity in that for us to be okay. But our strategy is pretty much still the same: diversified hybrid real estate investing model. The people who just did fix and flips or wholesales or just notes or had one type of investment strategy, where there's no buffer or a hedge against, what we're going through right now, those are the people who's going to feel the impact. So our strategy is pretty much the same: a mixed portfolio of real property and mortgage notes.
Excellent. One of the benefits of this happening is that it's happening to everyone. So everyone is going to be a little more apt to work with each other, because it's happening to everyone. So,
and you have to, you have to keep in mind, and go back, I guess, to Mark's question a little bit. Lenders are looking at all these deals right now as if this is the last amount of money I have to do this deal, would I do this deal?
Sure.
And so that's how everyone is looking at everything right now. And just keep that in mind. Like Mike said, have some patience, because secondary markets are frozen and people are having to.
Then we'll try to answer you offline. So I was going to ask who? Chris, you've been over there smiling the whole time. I haven't asked you anything. I'm sorry.
30.
So Chris is our financial advisor. And I'm curious, what is the majority of your clients? I know they've been calling you with questions and comments. What is the majority of the subjects of those questions that you've been asked recently?
Yeah, with most of my active clients, most of them has been thank you, right? Because we've been very cash flow focused, providing passive income, things like that. And I had one client who was in California that said, Chris, man, I am so glad I'm not in the market right now, because I just pulled out last fall, saved me $250,000 of losses, right? But I'll tell you the other side, the people that didn't hire me, even some from last fall, the same ones are saying, I just lost a couple $100,000 and I hope it comes back. One of them was supposed to retire next year, and now is saying, well, maybe I should work another 5 years, right? It's a fun time right now, depending on what perspective you have. It's definitely new in so many different ways, but I think the fundamentals are still the same. Biggest advice I've been giving my clients, even leading up to this, was get lean, get liquid, and get out, right? Obviously get lean in the sense of, like we've already heard before, right? Like make sure that we're trimming the fat, that we're kind of eliminating unnecessary expenses, like really putting our focus on how do we be as profitable as possible. Even if this is your own personal cash flow, how do we make sure you have enough cash to buffer? That leads into the get liquid. How do we make sure we have savings and money available? I've had people go, and I even told my clients a couple of weeks ago, I did a group call and I said, guys, everybody hit the bank, make sure you have a HELOC in place, get up to at least 80 or 90%, and then cash it out. And then as an extra measure of protection, move it to another bank, right? Just in case, because we never know what banks can do. Because if I learned anything from the last recession, what happened there is that banks cut limits like crazy. Once things got tight, and we're already seeing it in the commercial space, it will happen in the residential space here pretty soon, is that if we don't get that money out, it's going to be trapped in there. And there's some people who have been gambling and been, banking with their HELOCs, cashing out, investing, and then using all their cash flow to put it back in their HELOCs. Well, if they cut back those limits, all that money, all that cash flow you had earned is going to be trapped inside your home equity. And now you're going to be illiquid, and that's going to put you in a world of hurt. So that's what I mean by that is like, get lean, get liquid, and then get out. I can't legally tell anybody to sell off their stocks or mutual funds or whatnot, but man, like I remember when it was down 5%, I was saying, are you sure you want to be in this? And people are like, well, I don't know. I don't want to lose 5%. Now the market, even with a little recovery, is still down about 25%, and so at what point, psychologically people don't pull their money out, right? They just stay in there and ride it no matter how long it takes. Now, the question is, can I get my money out? And like what you guys just said, be patient, look for opportunity. Personally, I'm still buying properties. I know I even just been emailing Glenn, looking at some of his properties to buy for cash flow right now, while keeping other money liquid and available for later, about a 50-50 split. So that's kind of what I'm seeing. And that's kind of what's happening. Again, my clients are feeling pretty good because they have cash flow coming in. But for those that don't, the time to act is now.
Well, one of the benefits of the insurance program that you're always touting, the cash value life policy, is that you could take, here's a great strategy. You go ahead and get that HELOC or line of credit. You go ahead and get the cash. You don't have to worry about putting it in another bank. You can actually put it in a cash value life insurance policy, which will probably pay you more than what it's costing you on the interest rate you're paying on the HELOC, right?
Right. Exactly. You guys mentioned dry powder. I mean, if you don't know how long you'll be waiting,
free.
That's what's that?
And that part of it is tax free too.
That's right. It's tax free. It's kind of like a supercharged savings account / Roth IRA in a sense, right? Where it's tax free, get better returns definitely better returns than savings right now. Now that the rates have tanked completely. So yeah, I mean, there's definitely great options to be able to store cash, keep it safe. And another thing too, in most states, you can keep your money safe from creditors and lawsuits. So as we get on the other side of this, are people going to start getting sue happy? Are people going to try to get money from any place they can, because there's no doubt we're moving into a very deep recession as a result of this, if not a depression, just depending on how this all plays out. So protecting your money, staying liquid, make sure it's there, but still earning money on it too is, I think, absolutely essential right now.
Yeah. And if you're worried about it not being liquid in the insurance policy, you can easily borrow against that while the balance is still earning, and you can use that money to find those deals that have cash flow when those opportunities come up. So it's easy to get liquid in those accounts as well, and you still have that asset protection, right?
That's right. Yeah, it's all about how you design it, make it a minimal cost, maximum gains. It's definitely a big thing of it. But yeah, it's a great time right now to be able to protect what you have and then grow it too. I'm very excited for the opportunities because of the last couple of recessions I've weathered, this is the best financial position I've been in. So I'm like, I got my gloves ready. I'm like, I'm ready for this. Let's bring it on. We're all going to be affected in some way, but I've been preparing for the last decade for this next recession because I got hit so hard in the last one. So this one it's all new, but I still have a lot more confidence than I've had other times when we've been freaking out.
Excellent. Yeah. Well, I have, again, if you're just joining us, you can ask questions in the chat box, and we'll make sure we try to do our best to get to them before we end the show. I'm going to go with Jim's question, and he's asking what we're doing in our personal portfolio, in our own investments. What are we doing? Are we looking? Are we waiting? Have we made any changes? And I can tell you what we're doing in our fund. I already mentioned that we're putting loans on pause right now. The ones that we're working through, I can tell you we're getting advanced interest payments that are part of the deal. So we're putting 3 to 6 months in advance payments in an escrow account. Plus we're lowering our LTVs. Yep. And they're going to be properties, and we've already done this, that are going to be affordable housing. And we made that shift last year to go to strictly the affordable housing market with loans in our fund. Those are going to be the safest. They're going to be the ones that can create cash flow if they're not currently, but they're also the easiest to move if you have to, if you end up owning them, because the price points are low and everybody wants them. They're valuable assets.
Mhm.
So I'm gonna go around the horn and ask that same question to everyone. I'm going to start with Mike. Mike, what are you doing with your portfolio currently? What's your current strategy? And I'm going to say until you get better information.
Sure. So we're going through the entire portfolio. So one is a personal, the other one is obviously fund. But the exercise is identical. Is look for risky points. So what do we have in the portfolio we believe has exposure to these market conditions and to what extent, and essentially mathematically simulate a stress condition, assume things going to go really bad, and just project, what's our exposure, what are our risks, and the main question is what can we do about it. If there's nothing we can do about it, well, it's good to know that something is at risk, but if nothing we can do, there's nothing we can do. There are situations where we can obviously impact and make changes, and that's what we're looking for. We're looking for what's at risk and what we can do to improve, and then we're also looking obviously for the strengths in the portfolio. It's basically a review process. Go through everything, think through what you can do today. And obviously cost cutting. Where can we reduce risk, reduce costs as well? So cost cutting, increasing liquidity. We have pretty high liquidity at this point. So we have a lot of dry ammo, and we're actually very happy that we have about 50% of our flagship fund is in cash. And that's a lot of dry ammo, and that's been sort of preparation. We can't have too much cash in the bank. It burns a hole in essence, because we got to put it to work. But at the same time, 15% in this market feels pretty good. So that's the key basic step. We're having conversations with a lot of our project sponsors and borrowers, and understanding what's happening with their business, how we can help, what adjustments we need to make. There might be great opportunities where they need a little bit more liquidity. We can come in, save the project, which we already know, get a good return on incremental capital, and protect our existing investment. So that's what we're doing. We're analyzing existing portfolio because new deals are sort of frozen. So it's a time to look at what you got and how you can improve it.
Excellent. Thank you. Jacob?
We're just generally trying to be defensive, and we're trying to be more liquid. We're looking at more cost-cutting measures, not because we're out of money, but just so we can buy ourselves a lot more runway through this downturn.
Yep.
I mentioned it earlier, but we're focused a lot more on cash flow with new acquisitions. In terms of managing our existing portfolio, really our only problem area is our retail line of business. We're doing everything we can to mitigate that with rent abatement, cutting deals with lenders. But our storage business, as I mentioned, is not seeing any really negative effects from this yet. We're trying to acquire new acquisitions with long-term debt, so we're not up against a short-term maturity date, and we're trying to buy deals that aren't reliant on a low cap rate exit in a couple of years. Again, just more focused on cash flow. Personally, I'm not really doing anything different. We've got a rental portfolio of single-family residences and some storage facilities outside of our various institutional and private equity partnerships that we're holding on to. So not really doing anything directly different within our current asset base, other than just trying to manage risk and really focus on cash flow and downside mitigation.
Excellent. Glenn, you're up.
Yeah, very good. Obviously, what we're doing, we're in the affordable housing space, right? So it's business as usual for us. What we're already seeing, which is, we saw this in 2008, and I've seen it before. Prices are coming down fast. That's why the capital markets are freezing up. Fortunately, we have a lot of private investors that understand, that get it. And so, yeah, prices are going down. We're renegotiating some deals. And so from the business point of view, yes, we're tightening the ship. We're cutting all of our expenses and so forth. But no, I think everybody said it on this call, that cash flow is the name of the game. And, we think the cash flows are going to get better now. because the prices are coming down. They're coming down pretty hard. So, I think there's a real opportunity out there. I like what Chris said. I actually built my company for this because I knew it was coming, and of course I thought it was going to be 3 years ago, to be honest with you. So I'm late on that, but it was, we just knew the chart said there was going to be some kind of a reset here, and yes, with affordable housing, I totally believe people are going to do two things. Number one, they're going to eat. Number two, they got a roof over their head. And when you have the most affordable roof, I feel like long term we're insulated. Like I said, short term there's going to be some bumps on the road with rents and so forth. So that's our plan.
Mhm.
So that was you, the guy on the corner in Fort Worth downtown with the sign going, "The end is near."
Yeah.
No, that wasn't me. I always get accused of being too the glasses. I have too full. That's what I was accused of. But no, I mean, obviously, none of us could have projected the coronavirus, right? Nobody could project that. But the charts were screaming for some kind of a reset or a pause or whatever. So that's that's kind of what I learned in 2008, to try to have kind of a strategy that works, whether it's good times or bad times, and rentals of affordable houses, I think, work in any market. So that's my take.
Well, all of us as a group, because we are in all the same masterminds, we've all been preparing for the last couple of years because we knew the market was kind of at the top anyway, and it couldn't do anything but go the other way for a little while. You just need to prepare. You don't assume it's going to happen, but you assume it's going to happen. You just need to be in a position to weather it when it does. Yep. Fuquan, what about you? What are you working on?
Yeah, we did in the last 2 weeks, coming back from the CG event, especially, and knowing what was eventually going to be the outcome that we're in now, things slowing down with all the talk that was out there. We've actually been, any projects we didn't start yet, we are in the process of, putting those projects out for bid again to other contractors who may not be working anymore, give them an opportunity to get back into, doing the job, and giving us an opportunity to get the open contracts we didn't start at repriced. And we shifted most of the focus to finishing up the rentals instead of, having a big crews at the flip properties. We moved those crews over to the rentals because we have, pretty much a waiting list for the subsidized apartments. So we're trying to just focus 100% on getting that done while everything's in a slow period. And we don't know where the flip market is going to be. As far as the notes, we've really been paying more attention to the 10 out of 12 payments, the people who's behind 60 days, trying to offer, something that's more affordable, trying to see if they've been affected, and really doing a lot of bar outreach and staying in contact with our attorneys, organically finding out, what's happening in the local market, what courts are closed, pretty much all of them now, but really just focusing on that, really. In my personal portfolio, I've been looking, because I can't buy notes that the company owns, so I've been looking for onesie, twosie notes that people may want to sell for liquidity. I'm doing some hypothecation. I've been on the phone with my bankers, trying to execute on the lines of credit that they've been trying to get me to do for the past 4 or 5 months. So just focusing on that, really, and just keeping up and making sure that I'm on phone calls and I'm over communicating with investors, and keeping my ear to the street on what's happening.
Mm-hmm. Great.
Excellent. Chris, what about you?
I kind of already alluded to it before, but my personal portfolio, we've even pulled whatever little money we had in even gambling and Bitcoin in the stock market. We're pulling it out. We're getting it out into our hands. Liquidity has been the main thing, right? So, like, for example, personal savings, we made sure we had at least 8 months worth of expenses, that we could ride on for business and personal. Now, naturally, because I don't want that earning 0.0% in the bank, we got a good chunk of that in my life insurance policies and things like that. So it's stored up and it's waiting. But actively, like, there's still deals I'm looking for. So specifically, I'm looking at turnkey single family homes. I mentioned Glenn's stuff and, things like that. I've been looking at other funds for money down the road, as well, with syndications, much like the funds that you guys have, that you guys are offering as well. And so it's really a matter of like, hey, I've got money sitting here. We got, worst case scenario, if income stops completely, we're good for months. We can weather this out and be fine. but we also got investment money over here as well. Another chunk that someone's going to be actively investing currently, getting some more cash flow, keep building that up while keeping more cash on the side of saying, all right, we see what's coming. Hey, what if these big box stores, all these malls and things go out of business? Are they going to start turning into self-storage? Cool. Is that what the direction we're going to start moving? It's just watching and just waiting in a lot of ways. And, like I said, it's a fun time right now. The one thing I know I'm not investing in is we're definitely not putting money in the stock market. It is not at the low. Whenever I hear people say, hey, we should dollar cost average, we should put money in now because it's at the low. It's like, that's the dumbest time to put it in. When have we ever had a recession where it dropped in 1 month and then recovered? Never. It takes a couple years. So that's the worst time to put money in, but real estate, I think, is still one of the safer places to be in right now.
Yeah, agreed.
Well, God is only making so much more land, and it's not inhabitable very quickly. The volcanoes are what adds land, and it's going to take a while for those to be occupiable. So whether it, obviously residential is the most coveted, and people always need two things: food and shelter. And so you can, if you're going to invest in the stock market, do it with grocery chains.
yeah, no kidding.
Otherwise, keep it in real estate. So listen, I want to thank you guys for joining us. I do want to mention with the bill that was passed last night, I'm sure there's going to be some other changes made to it. So don't take the details you see and hear about right now to heart. There's going to probably be a few adjustments. Mm-hmm. And if you're in a position where you think these loans are all going to be forgivable and you can't afford to pay them back, don't get the loan because there's no guarantee they're going to be forgivable either. Wait till the details come out. And again, call your banker, get in the position. If you can get lines of credit and get liquid, I suggest you do that. You don't want to put it under the mattress, but at the same time, don't keep it in the same bank that gave it to you.
Yep. No. Great.
Anyway, that said, we're going to be doing this once a week for the foreseeable future to kind of give everybody an insight to what's going on in our world. Mm-hmm. Again, thank everybody for joining us.
And please leave comments because as much as we want to give you an insight into our world, we want an insight into yours, and that's how we all grow and get through this together, is insight from both sides.
Oh, and don't forget to like and share and subscribe. All right.
And hey, Bill, Jonathan, great job, you guys. Great job.
Well, thank you very much.
Thank you.
Thanks again for joining us, guys.
Yeah.
Thanks, guys.
See you next week.